Welcome back to Market on Close. I got Nate Peterson joining me for Big Picture Chat into the belly here, Director of Derivatives Analysis at the Schwab Center for Financial Research. Nate, good afternoon, sir. What do you think about this market?
Pretty resilient, holding up. It feels like yesterday was the first time that we've really seen, some of this downside pressure on stocks, I think primarily driven by yields. Maybe, we're 12 days away from election day, so perhaps we're starting to kind of creep towards that maybe tentative price action as we await election results. But yeah, down 1% from last Friday. So, if you look at the technicals, the S&P basically just, kissed its 20-day SMA yesterday, and we kissed it again today, still in an uptrend, fully valued here at a forward PE of 22, and then you've got the VIX, at 1920. So if you're an equity trader, even an investor, you could consider if you're, I would be surprised if we just continue to melt up higher through the election and not encounter some kind of bout of volatility, perhaps like a sell on the news after we get the election results, or the week before elections, maybe we get some profit taking in order to take some exposure off. One of the two would not surprise me. And if you're a trader or an equity investor, you could consider, because the VIX is at 19 or 20, collar a position. Because volatility is expensive right now, people have been buying protection, selling out of the money call to purchase that out of the money protection as a consideration, not a recommendation. There are trade-offs with that. But at a forward PE of 22, I just don't think we're going to rip higher right now, which makes it seem like it might be a strategy that makes sense given the current setup.
When you got the end of year coming up, Jem Carson was telling us that that's where there's going to be a lot of flows and just kind of pent up positions that need to be realized or taken off by then. How much weight do you put into the calendar, Nate?
Well, gosh, November and December, they're usually just great months for stocks. And if we get some type of a meaningful pullback, I'd say 3 to 4%, maybe even 5%, sometime between now and the next 3 weeks, I think that would bode for a good setup heading into the end of the year. I mean, if you think about why are we at a forward PE of 22, it feels a little bit like we're having our cake and eating it too, meaning that we're getting EPS expansion and we're getting the Fed that's on our side. I think the risk to that would be that we're not going to get as many rate cuts as the Fed, signaled last month at the September FOMC. If you look at how the markets reacted, they were expecting just 5 weeks ago 175 basis points of cuts between then and the end of 2025. Now we're down to 125 basis point of cuts between now and the end of 2025. That could even go down even further, I believe, if the economy is able to hang in there. And if you take a step back and say, well, what's going on here with the economy being so strong and resilient, then why is the Fed cutting? Well, the whole reason this happened, I believe, is back to that weak, soft jobs data that we got in July and August, the creep up in the unemployment rate, those weak non-farm payrolls reports, that kind of triggered the Fed to say, we need to protect our other dual mandate, the employment side. And so that's why they begin to say, you know what, we need to start cutting because we don't want to risk, or jeopardize the economy. But then you look at the labor data since then, and just look at the claims numbers from this morning. It still seems really firm. So this economy took 525 basis points that were raised in its face. We never really got a recession outside of some of the pockets like manufacturing. So it's been a very strong economy, and I think we're going to have to kind of pull back our expectations, temper those expectations around the Fed and Fed cuts. And if that's the case, then we'll have to keep an eye on the EPS growth to make sure it stays intact.
I like that you bring up the claims from this morning, coming full circle. We started the hour talking economic day, but we didn't really talk the claims. Real quick, do you put weight into the continuing claims? Because the negative argument would be that's trending still higher.
Well, yeah, it is, certainly. And you would expect some of that softness to occur. And then, in terms of the turnover and people seeking out new jobs, that isn't happening at the pace that it was. And so we've seen the JOLTS data kind of creep lower. But it's still, I think, 7.8 million was the JOLTS data from the last figure. That's still above pre-pandemic levels. So, yeah, certainly some softness has been there. But I think the expectation, if we were to go back to the beginning of August when we were having that volatility bout and we were having the yen carry trade concerns and all of that was going on, I think the expectation was we're going to continue to get further evidence of labor market deterioration. And it feels like it was just basically for 2 months that we saw a lot of that weakness. And since then, unemployment rate has fallen from 4.3 to 4, now to 4.1.
Yep.
Yes, some softness, but still very firm.
All right. Appreciate it. Thanks, Nate. Nice closing thought for us on the macro. Mr. Peterson is Director of Derivatives Analysis at the Schwab Center for Financial Research. 1 minute.